get all this technology to work, but I don't have Eddie Engineer. I am him. So it's just me. Hope it's working. I believe it is. The indicator lights are green. So if I lose you, here's the deal. Please give me plenty of mercy and grace if technology doesn't work the way we hope. But what I want you to do is, this lesson is actually on real estate investing. It's on real estate. And as you know, Dave Ramsey loves real estate. I have a different feeling. So I'm going to share some of my observations about investing in real estate from the perspective of a financial advisor who works with clients. So I'm going to do that in today's lesson. But what I want you to do is, those of you especially who said you wanted this lesson, because typically we don't really even do this lesson. It's the final, the 12th lesson in our course. And it's really, we usually replace this session with a recap, an overview, kind of a capstone lesson. So we're going to do that capstone lesson, but it won't be today and it won't be next week. So announcement, we won't be meeting next week. I know I told you we would the week of Thanksgiving, but I'm going to be in Myrtle Beach with my grandbaby, my daughter, and our family, so I won't be available next week. So we'll do it the following week. But what I want you to do today is post your questions, especially those of you who really wanted to do a lesson on real estate, because chances are I'm going to go over some things today as we highlight this week's lesson, but I'm going to miss everything you want unless you tell me what you want specifically. So you've got a ton of information from your studies, your videos this week, and I've not yet reviewed all of your homework assignments, but I'm looking at one right now, and I don't have permission to share the person's name, so I'm going to try to hide that. But I know who it is. It's an excellent paper, and it just gives the definitions that we went over this week in real estate. So again, post your questions. If you have questions that are specific to real estate, I'll do another show, another episode, another lesson, and I will post it. I may do it, I'll do it live if the technology is working great. But even if we lose you, even if I lose you because we lose our connection, everything's green right now, it looks great. But if that changes and I lose you, then it's going to be like, see ya. I'll try to reestablish the connection, but if that doesn't happen, then we'll be done for today. But that doesn't mean you can't post your questions down below and post them right here on this post, this Facebook Live post. I'll read them, and I'll come back and I'll answer your questions in the form of another lesson. But that's only if you ask some questions that are relevant to this lesson, because I would prefer to move on. I'm really looking forward to that special extra credit assignment that you're going to do, which will be the 20 top tips, the things that you learned in this course that you believe will help you in personal finance moving forward. So that's going to be my favorite extra credit assignment. Remember, I'm only posting this assignment, this extra credit assignment, for those of you who have not yet achieved an A in the course. And as you well know, you need 950 points to get an A. There's no such thing as an A+ at the Bauer College. So the best you can do is 950 points, which is an A. And many of you have already achieved that. So this class today is optional for you. For those of you who don't have an A, you better leave a comment so that I know you attended, so that you need to be here. Because we're supposed to be in class on main campus. But anyway, so enough of housekeeping, I think. Let's get into the lesson. Oh, before I do, there were 3 things I wanted to ask for your help. Number 1 is ratemyprofessors.com. Please do that for me. Number 2 is like this page so that you're notified. If you're a Facebook user, you'll get notified whenever I post either a Facebook Live or just a follow-up lesson. I'm going to be using this technology more and more in the course, and since you're graduating and you will be out of the course, I want to invite you to stay connected with me, and this is the way I think it will work well. So like the page, leave a comment down below, and I'll look forward to seeing those comments. I would go to the Facebook page right here right now and show you on my iPad, but it seems like every time I go somewhere on this iPad I lose the connection, so I'm just going to stick here. So number one, ratemyprofessors.com. Number two, like this page. And number three, you're about to get, or you may have already gotten it, I haven't posted it in Blackboard yet, but the course evaluation for Bauer College is very important. It's important for me, and I hope you'll do it for yourself, for the college, and for me. Now I see I'm getting some red, which is a bummer. So if I lose you, I'm just going to reestablish the connection. I don't know what to say here, except that's a bummer. Well, I am recording, so I'm going to just keep recording, and I'll post this. I'll post this to Facebook Live when I'm done. So that's going to be weird because I'm going to have one Facebook post and then part two. This is part two. So part two picks up where part one left off. So here we go. Real estate. Let me give you my 2 cents on real estate investing. I've had lots of clients over the years who really believed that real estate investing was the best way to get a return on their investment. So investing in real estate is one thing. Buying your own home as kind of an investment is another thing. And so, you know, which of those topics should we tackle today? Let me try and tackle both of them in a very short amount of time. And then, again, you post your questions, and I will be happy to answer them. So, still trying to go live, but it's not letting me. So I'm just going to keep the recording, and I'll post the recording. I'm so sorry about that. So real estate investing, as an investor, if you're going to flip houses, if you're going to invest in real estate, in my opinion, that's a lot of work. That's a difficult way to get a return on your investment. And here's why. I live in Houston, Texas. So Houston, Texas is a great place to live. It's a great place to invest. But if you're investing in real estate, you have some extraordinary fixed costs. For example, I just paid my my real estate tax. So that's expensive in Friendswood, Texas. So if you're going to flip real estate or own real estate as an investment, you've got to think about taxes. Number two is insurance. We live on the coast, and A, it's difficult to get insurance, and B, it's expensive to get the right kind of insurance. You need wind, you need homeowners or rental dwelling. It's a different policy. If you're investing, it's a different policy to protect your home or your property than it is your home. As you'll recall, when we did insurance, we talked a lot about homeowners insurance. We did not talk about commercial insurance because that's a whole nother topic, a whole nother arena. And insurance for your home is a pretty good value. It's very expensive, but it gives you really broad coverage because insurance companies know that you live in your home and you will take care of your home. And so it's a lot easier to measure that risk than if you have a renter in the property. So if you're an investor, you have to deal with commercial insurance, which is more expensive, more difficult to get, and it also is much less comprehensive in terms of coverage. So the cost of insurance is number two. The second reason that I would say you need to really think twice, do the math before you start to invest in real estate as an investor. So you've got taxes, you've got insurance, and my favorite, my least favorite, is maintenance. Now, again, in Texas, because of the sun beating down on the roof, the winters, the wind, the hurricanes, things that may not turn into an insurance claim or may not be covered because they're specifically excluded for coverage under your insurance policy become maintenance issues. Foundation movement. Like I said, the roof getting just choked by the sun, cooked by the sun, literally cooked by the sun, is another big cost and exposure or risk that could cause your return on investment to be reduced. So those are the reasons I'm not really a big fan of being a real estate investor in terms of buying property, flipping property. So you've got all the maintenance and repairs that have to happen. You buy a property, a piece of property, thinking you're going to make some money on it. Maybe you're going to live in it for a while, fix it up, and then sell it. There's just so many exposures, risks, and so in our lesson this week, we talk about mostly buying a home. So we can focus now on what does that look like to purchase a home versus being an investor. If you're going to be an investor, you got to do the math. And the return on that investment, for so many reasons, could be much less than you hope. And so there's lots of other ways to invest in real estate besides actually going out and buying a property and fixing it up. And those are the ways that we really recommend to investors who want to make money in real estate. Lots of ways to make money in real estate. My least favorite is to go buy a bunch of homes and fix them up and rent them out because of the cost of taxes, insurance, and maintenance. And when you have someone abusing your property, we have a rental property in our neighborhood that is just a disaster. And if you're the landowner, the landlord, it's your responsibility to keep that place, safe. And anyway, so investing in real estate, if you want to be a flipper, is not my recommendation. Now, again, Dave Ramsey has a lot more, he has a very different perspective about investing and specifically investing in real estate. So it's another one of those areas where I think my philosophy and my approach and my recommendations, if you were a client, or if I were just Uncle Jim helping you with investments, I would shy away from investing in real estate. Now, owning a home is a whole different deal, and that's Say Goodbye to Renting and Hello to Owning, the title of this article. Great job. This is mostly definitions, and I will get permission to post this so that if you want to see it, you can. There's some great definitions. But buying a home as a homeowner is a whole different deal because you need a home. You need a place to live. And it typically does make sense to buy a home versus renting, especially if you're young and you have your whole future in front of you. I will tell you, though, that at some point, and I think I'm getting to this point, I start to question whether or not owning a home. I have a pretty big yard. I just went to the bank and got $1,200 to pay the gentleman who came and cut my trees down. $1,200 just to cut the trees, trim it up, clean it up. It took them all day, and they're coming back today to get their money. But that's just one little thing. I could go on and on and on and share about how the cost of maintaining a home may not make it the best option for me and my wife. We don't need a house this big. And we've got a swimming pool. There's all the maintenance. We redid the pool this summer. So owning a home is great in terms of an investment if you're a homeowner as opposed to paying rent. I believe that's true for you especially. But there comes a point where you may want to go see things, live somewhere else, not have the maintenance, and then, depending on where you are in life, it may make sense to downsize and rent. So, not sure, again, it It's a mathematical equation that has to be done for each person and each situation. So, I mean, think about it. We could sell our house. I would guess we could sell our house for somewhere around $300,000. Put that in the bank. What kind of return could we get on that $300,000 to use for rent? Probably we could pay our rent for the rest of our lives based on the equity we have in the house. House is paid for. We don't have any debt. That's another thing about owning a home that you want to understand is you get a deduction for your interest on your home loan. And interest rates are rising. So over the last several years, you could get a mortgage for 3%, 3.5%, 4%, and those rates are going up. And so that's a deduction on your income tax return. At least it is currently, I believe. They didn't change it. But remember how those tax codes work. At any time, the phone could ring. That was the prop that we used in a video. It's the IRS, and things change. So anyway, that's kind of the short version of investing, both in terms of being an investor in real estate and a homeowner. So I hope that helps. Again, I'm looking for your questions. You guys did a great job this week on your homework assignment, and I think you probably have answered most of your questions. As usual, that's how it works. So I'm going to move on, and we've spent about 17 minutes on real estate investing. And so now I'm just going to move into kind of a review of the last 2 weeks. So the last 2 weeks of this course, investments and retirement planning or retirement accounts, those are in some ways the most important. I guess they're very important. All of the lessons I think are important, but these two are specifically important if you want to build wealth, if you want to have a plan that really works to put you in a situation where you're going to be able to retire with dignity. So if we look over the the syllabus, if we just look at the lessons that we covered in this semester, you'll see that we covered a lot. We didn't have our pizza party. That would have been nice. Let me see if my notes are working, if my little Apple Pencil is working. Ah, it's working. Yeah, we didn't have a pizza party. We usually do that. I don't know what happened this semester. I do know this. I've put on some weight, and having a pizza party is never a good idea for me, because what happens is I buy tons of pizza and I take it home. I give it away and I take it home. I end up with pizza for 3 days for breakfast, so we didn't do that. Your retirement or your spending plan is an assignment that I haven't graded yet. This is, by the way, just for those of you who are watching and aren't part of the course, or maybe you're thinking about being part of the course in the future. The spending plan is something we do. It's a homework assignment 3 times. First time, it's just an introductory. Kind of get used to setting up a spending plan or a budget and tracking it. And I ask for 3 things. We do this assignment 3 times, and I always ask for 3 things. Number 1, I want to see the data. I want to see what you spent. I want you to see every penny that you spent for 30 days. Number 2, I want to see a graph that depicts, kind of shows a picture of the categories of your spending. Over the last 6 years, as we've done this assignment, that's been the most valuable thing that students share with me, is that they get to see, you get to see where you're spending your money. It's very helpful. So, and number 3 is, so we've got data, we've got the graph, and then I want you to just share, you know, how's it working for you? What's it like? What was your experience? And so with that, we get to, you get to reflect, and really, I guess my number 1 goal is to find out if you feel like this assignment is worth doing moving forward. So at the very beginning of the course, the first assignment was for you to select a tracker. It's so cool what you can do today with a mobile app. Most students, I'll just make this simple, most students select mint.com. It's a great app. It can track multiple accounts, multiple spending vehicles. For example, I use a credit card for my home, personal, and another credit card for business. Mint.com lets me bring all those streams of expenses into one place. In addition to that, I can integrate or aggregate, that's what we say in the business, aggregate multiple accounts, such as my investment accounts at TD Ameritrade, Charles Schwab, E-Trade, Morgan Stanley. It brings all of those investment accounts into one place so that I can see a total of my investments in each account and where they are, up or down. And it gives me a snapshot of my net worth. So I can include debt, I can include investments, assets, and I can include, most importantly for you in this exercise, is spending. Where is my money going? So that assignment we do 3 times, spending assignment. And we do the first 30 days, which is pretty, I don't grade it very difficult. I mean, I give you lots of grace. The second time we do it, it's a little bit more about being accurate and really having a good system for yourself. The third time, basically all we do, and this was your assignment this week, the last week of the semester, is to take 2 months of spending and integrate it into one assignment where you show your spending over the last 60 days. Really all you're doing is taking the first 2 assignments and consolidating them. I have not yet graded this, so if you're still trying to work towards that A, that's 110 points, as you can see. So we will be doing that later today and over the course of this week. I will be grading that. Great job. I would show you one right now, but I'm going to move on to the review of the last 2 weeks. Because like I said, investments and retirement, these two lessons, in my opinion, are probably the most important. So let's review. One of the things I've mentioned at least 6 times this semester is the perfect investment. The story goes like this. Assuming you get your dream job and you're making, let's say you're making $100,000, just to keep the math simple. And let's say that you are actually getting a 6% match from your employer. So $6,000, here's what I want you to do. Here's what I have recommended, suggested for 6 years. And multiple times for you in this course, in this class, in this semester, is on day 1, when you start your dream job, what I want you to do is be ready when you get the forms from HR, Human Resources. You're going to have to make some elections. You're going to have to make some choices. And you need to know what is the match that your company is going to give you. That match, in this case, 6%, is the minimum that you want to invest in your 401k. So the perfect investment means you need to understand what is your 401k account, why should you invest in it, and how much, and what should you invest. So we covered in the last 2 weeks, we really worked through all of the details related to taking advantage of the perfect investment, because there's a lot more to it. But the simple thing that I want you to be able to do is day 1, be able to know what your match is so that you can check off the box and say, yes, I want to invest in my 401k, at least 6%, which in this scenario is $6,000. So you say, yes, I'm going to contribute $6,000 over the course of the year. That's $500 a month. The beautiful thing about the perfect investment is that with that match, your company is going to match 6% of your income. That's $6,000. So if you put $6,000 in and they put $6,000 in, that's a total of $12,000. That equates to 12% of your income. Now, we rehearsed the baby steps, Dave Ramsey's 7 baby steps, and one of the big steps was to invest 15% in your retirement. So if you just do this one thing, you get really close to investing 15%. Now that's 12%, but at the end of a year, you've put in $6,000, the company has put in $6,000, and you have $12,000 in your 401k. It's the perfect investment. There's no other investment like that, except maybe if mom or dad say they're going to match. We've done that with our kids. If you save $50 for your bike, we'll put in $50 for your bike. Same kind of deal, except way bigger, way better, and you need to be doing it over your lifetime. So the perfect investment, check that off my list. I've explained it to you now at least 3 times, I think 6 times. And so make sure that you know how to do that. If you have any questions, let me know. I'll do a whole lesson on the perfect investment at some point. So then 2 weeks ago, we covered investments. In that lesson, we covered 4 strategies, 4 investment strategies designed to help you maximize return and minimize risk at the same time. So just to review those 4 investment strategies. Number 1, diversification. I told the story about Eleanor, whose husband, Mike, worked at Enron. And he bought into the whole story of those Enron dudes who said, never been a better time to invest in Enron as the ship was sinking. And he had $1 million, almost all in Enron stock in his 401k, and it disintegrated when the company went down. And he died of a heart attack that left Eleanor with really nothing. So that's the story I tell to just illustrate the importance of this one very simple, very basic investment strategy that helps you maximize return at the same time minimize risk. I also told the story about one of my clients who worked for Enron in middle management, and she was much smarter. She didn't drink the Kool-Aid, and she diversified. And so when we worked together, it was a whole different story. She was in really good shape. So number 1, diversification. Number 2 was asset allocation. There is no more important investment strategy that will determine the outcome of your portfolio than asset allocation. So we went through different types of assets, from large cap stocks to small cap stocks, international to emerging markets and bonds. And I encourage you to learn more about different asset classes, because asset allocation, which is the most important determinant of your portfolio's returns, is asset allocation. Asset allocation, I already said that. It is the most important determinant of your portfolio's returns. And asset allocation is really a lot like diversification on steroids, because you get different classes of equities and bonds that react differently when the market goes up and down. So let's just look real quick at the market just to kind of do a quick illustration. Everybody's asking if everything's okay. I'm sorry we got disconnected, but I'm going to post this soon. Anyway, if you look at the 3 indexes, we talked about 3 indexes in class, and you can see all these different stocks. If you just pick this one, this is the SPY, S&P 500, and it's going to go up and down over time. You see over time, though, it goes up. And by the way, this is my favorite investment of all time. It is another thing we talked about in the investment class, which was types of investments. Dave Ramsey loves mutual funds, and I love ETFs, and this is an ETF. You can see that it trades in a pretty high volume. So I'm not going to go deep into types of investments. I'm just going to say that different assets have different returns. Like you see right now, the SPY, which is the S&P 500, is up today. And this is typical. And today, the TLT, which is a bond, 20-year bond, it's down. And that's the whole point of asset allocation is, in addition to being diversified, you want to have good asset allocation so that when one asset class is going up, another one may be going down. That takes us into the third investment strategy, which is dollar cost averaging. Dollar cost averaging, as I told you, is the most powerful investment strategy there is, especially for younger investors who are in the accumulation phase. So we used the example of Farmer Joe, and I think I'm going to see if I can find the picture of Farmer Joe. I'm not finding it. I should have had that. Sorry about that. Anyway. Not finding Farmer Joe, but you may recall I should do a whole lesson on dollar cost averaging. Dollar cost averaging is it's the most powerful investment strategy of all, because what happens is you set up a systematic investment plan and you're investing every month, and this works in your 401k in a great way. So when the market's up, you're buying less, but when the market's down, you're buying more. And if you have good asset allocation, what happens is you're doing that across all the different asset classes. And over time, nothing will be more powerful to combine those two strategies, asset allocation and dollar cost averaging. So that was a big one. And the fourth investment strategy that I taught you that helps you manage risk and reward, maximize return and minimize risk, is portfolio rebalancing. And if you just think of a chart, I bet I could do that real quick. Just drew a circle. My pen isn't working. Technology is so much fun. So I keep getting these great comments. Students who are trying to log into the Facebook Live, but we lost the connection, so I'm recording it and I'm going to post it later. Sorry about that. So this is your portfolio. And let's say that in one quadrant you have large cap stocks. That's the SPY. You could just buy that one. You could buy that one ETF and have large cap. And then you have over here, let's say you have small cap. I think the QQQ is a good ETF for that. And then over here, let's say down here you've got bonds. And then finally, let's say we've got emerging. Let's say we've got international. So imagine this is your portfolio. You got 25% in each one. But what happens is, at some point, international is going to shrink. It's just going to drop. But large cap may just get bigger. So portfolio rebalancing is pretty simple. You just sell, take some profits from that part of your portfolio that has grown, and you invest it in that part of your portfolio that has shrunk, and that is portfolio rebalancing. It's similar to dollar cost averaging. And I would set that up. A lot of 401k plans and investment plans have portfolio rebalancing built into their system. So you just check that and say, yes, I want to do that. And then what happens is you're basically getting the benefit of dollar cost averaging as the money goes into the account. And then in addition to that, you get kind of more dollar cost averaging as you rebalance your portfolio. So those were the 4 investment strategies designed to help you maximize return and minimize risk. Those are it. Diversification. Asset allocation is number 2. Dollar cost averaging is number 3. Portfolio rebalancing is number 4. So that was investments. Those are good terms to remember. Just plant those seeds and let them grow throughout your investing life, and you will find that Warren Buffett was right. Investing is not like Olympic diving. You do not get extra points for difficulty. It's simple. Those 4 strategies will help you become a millionaire by age 50, and especially when you couple them with your perfect investment. So that's all I got on investments. The following week, that was last week, we did retirement accounts, and we spent a good deal of time reviewing basically 4 types of accounts. Generic terms. Number 1 was non-tax qualified. Remember, I used the big plastic bucket to illustrate a non-tax qualified account, type of account. The second bucket, let me make some notes here. First bucket was non-tax qualified. The second bucket was 401k type. And we talked about not just 401ks, but we've got 403bs for nonprofits and TSP for government, but it was just a generic term, a 401k type of account. You need to know what that is. Review your notes if you don't recall. That was a very important lesson. Number 3 was the IRA, and we're talking about tax deductible. And that's one of the distinctions between the non-tax qualified and the 401k type of account, is that it's tax deductible, which means, again, if you're making $100,000 a year and you're getting a 6% match and you go ahead and contribute $6,000, the IRS says, hey, you only made $94,000, which means you only paid tax, income tax, on the $94,000. So it's a heck of a deal. The same thing is true about an IRA. You can set up an IRA, an individual retirement arrangement. We call it IRA, individual retirement account. If you're in the right income range, which most of us are, you can deduct. This year, I believe it's up to $6,000, $6,500 if you're over 50. You can deduct that. You can contribute to that in addition to your 401k. The 4th type of bucket, which we really spent a good deal of time on, was the little gold bucket. And the reason it was gold is because it's the only tax-free, not tax-deferred, but tax-free investment I know of, and it's the Roth IRA. You do not get a deduction for the Roth IRA, but you do get the earnings are tax-free. So again, remember, we used the example of Apple stock. Assuming you invested back in 2009, my buddy Adam Hayes, hope you're doing good, we were looking at Apple stock at that time, and we were trying to figure out, should we invest in Apple? So at that time, Apple was trading at $125 a share. Now today, you see it's $195. It was $200 last week when we did this lesson. It's dropped $5. In fact, if you look at the chart, you can see that Apple stock has dropped a lot in the last 3 months, significantly. If you look at the max chart, Apple stock has gone up, up, up. And if you look back at 2009, you'll see that Apple stock, well, if we would have bought it at $125 a share, where would we be today? You say, okay, $195, we made, wow, how much did we make? We made $70 a share. But that's not accurate, because at some point Apple stock did a 7-way split. I think they call it a reverse split. They split. So they took one share. Apple stock was going up from $125 to pretty high. Let's say it went to $700 a share. And then they split it 7 ways. So now each share is worth $100. So today it's worth $195. So let's unpack that. Assuming back in 2005, my buddy Adam and I decided we were going to invest $100,000 into Apple stock, we would have, 125,000. No, we would have 1,000 shares. 125 would close to 100 shares. Let's say we would have bought $100,000 worth of Apple stock. Today, how much would that be worth? You say 195,000. Let's pretend it was $100 a share, just to keep it simple. We bought $100,000 worth, and today it's 195. So that's 195 grand. But remember, it split 7 ways. So today that stock would be worth, really, I said almost $1,400 if it had not split. So last week it was at $200, and that was the truth. Apple stock, 1 share, basically worth $1,400, and you bought $100,000 worth of it. Now it's worth $1,400 a share. That was $1.4 million in the example. So back to these types of accounts. If you would have invested that in a non-tax qualified account and then decided to sell your Apple stock, you'd have a taxable gain of like 90%. I mean, you invested $100,000. Now you've got $1.4 million. So that's $1.3 million of gain. That's a massive gain. You're going to pay a lot of tax on that. However, if you would have had that in an IRA, I had $100,000 in my IRA. If I would have invested it all in Apple stock, today that stock would have been worth basically $1.4 million. And if I decided to sell all of my Apple stock because I'm afraid that Apple stock may keep going down, then I would be basically holding a lot of profit, but it would be in my IRA, which means I wouldn't have to pay tax on that transaction. So the distinction between the non-tax qualified account and the 401k or the IRA is the tax deductible, and there's no tax on the transactions here. So you can't really do that in your 401k because you don't get to invest in individual stocks in a 401k. But just understand that the type of account that you invest in is really important. It's not the investment, it's the type of account. And so we got in a little bit to what do you invest in, things like Apple stock or the SPY, which is an ETF, or maybe you like Dave Ramsey and he says mutual funds. That's an investment, and it's depending on what type of account will determine a big part of your return because of taxes. And then the Roth IRA, we just wrapped up types of accounts by saying, look, let's say you had $100,000 in your Roth IRA in 2009 and you invested $100,000 in Apple stock. And today you decided to sell it all, or last week when it was $200 a share after the 7-way split. $1.4 million, you made $1.3 million in profits, and you paid no tax. So you take the money out after 59.5, and you pay no tax. That's why it was a gold bucket. So those were the 4 types of accounts that we highlighted. And again, I think that knowing types of accounts as an investor, as someone who's working towards building wealth, is just as important, maybe more important, than what you're going to invest in. So I gave you some investment strategies. The number 1 is the perfect investment in your 401k. I taught you some basic strategies that combined work together to maximize return and minimize risk. I hope you'll keep those in mind. And as you learn more and grow more and have more, invest more, they will make more sense, I promise you. So we've set the table for your future, and it's going to be, I think, a beautiful future. And I've enjoyed being with you this semester. I hope you'll set up some types of accounts that make sense. I get lots of questions from students who want to know, should I invest in my IRA or my Roth IRA right now? And first question I ask is this, a question you need to ask yourself. What's the money for? What do you need or want to do with the money? And if it's anything other than retirement, then you don't want to invest in a 401k or an IRA or a Roth IRA. Those are retirement accounts. The reason they're retirement accounts is because you get penalized for taking the money out before you're age 59 and a half. So, it's a big goal for most people to be able to retire with dignity, to be able to have options in your life when you get to be my age. So I couldn't be here in my studio doing what I'm doing on Facebook, kind of live. We lost our link, so I'm recording this and I'm posting it live. But I couldn't be here doing what I'm doing what I love, if I hadn't planned using retirement types of accounts to do that. I made a lot of money in my career. And during those years that I made a lot of money, which isn't this year, making a lot of money is a good reason to have a retirement account because you get a tax deduction. So for all those years I was making a lot of money, I was paying very little in taxes because I was storing up for the future using retirement accounts. And I have enough money so I don't need to tap into those. I'm not yet 59 and a half. I'm 56. So, I think that the best advice I ever got about financial planning when I first became a certified financial planner was from my friend JD. JD was a guy that I coached Little League with. My son and his son played on the same team. We had a great time. He was passionate about Little League baseball, and I was just kind of a do whatever he said kind of guy. And JD came into my office after I became a CFP, and he wanted to talk about his financial plan, get a second opinion, have somebody look over his shoulder. And he drove to the office in his old minivan, which, that's what we drove back then. We had kids. He lived in the same neighborhood I did, over here in Forest Bend in Friendswood. And, little house, 3-bedroom house. I think we had 2 bathrooms in each of our houses, 2-car garage. But it was a basic kind of entry-level home neighborhood, and that's where he lived. And he came into my office, and my office as a State Farm agent when I was when I first became a certified financial planner was in Clear Lake, and there's some really nice real estate in Clear Lake. And I had a lot of clients who lived in a really nice house, and they drove to my office in a Lexus or a Beamer or a Mercedes. But when I would sit down with most of the folks, I would find that their biggest issue, the thing that kept them awake at night, was debt. And financial planning for them was, how do we get rid of our debt? Yet they lived in this massive house, and they drove these awesome cars, but they didn't really own any of that stuff. The bank did. The credit card companies did. Anyway, when JD showed up in my office and laid down his statements, the dude was a millionaire. And I was like, how do you do that? And JD's story impacted me. That was years ago when I first became a certified financial planner. But his story was so simple, so clear, so compelling, that I decided I was going to do exactly what JD was doing because it worked, and I saw the proof right there in those statements. And I asked him, how did you do that? He said, Jim, I'm not really smart about financial stuff, so my plan is really pretty simple. He said, when I started working, the government would let me put so much money into my 401k, and I did that. I put as much as I could. Whenever I would get a raise, I wouldn't change my lifestyle. I would just first pay myself in my 401k. He said, and then in 1998, The IRS came out with this really cool thing called a Roth IRA. And you know what he said? Even though my wife doesn't work, she qualifies for a spousal contribution. So I did that too, he said. I filled up those buckets. And what JD was telling me was that the IRS has certain rules, boundaries, and limitations, and he just basically learned how to take full advantage of those. That was it. Thus, when I started teaching this course at the University of Houston, I came up with 3 laws for personal finance. The first law of personal finance is the law of spending and saving. Spend less than you earn so you can save more for what matters most. Guess where I got that? Well, not just JD, but for sure, JD lived that law. The second law of personal finance, this came straight from JD, is the law of tax-advantaged investing. That's what I've been telling you. These types of accounts give you the ability to take advantage of the second law of personal finance, which is the law of tax-advantaged investing. The IRS makes the law. Your job is to take advantage of it. And that's why I teach you these types of accounts. And the third law of personal finance, which is the one that I believe makes all the difference, is the law of purpose and commitment. My question to you, all through this semester from day one, is what's your purpose? Why does it matter if you manage money well or you do like all of your friends do and just kind of wing it? Why does it matter? When you get really clear about the answer to that question, when you really clarify your purpose in life, you won't have much trouble committing to doing the small things that are required to achieve the really big things that you could never do if you didn't do the little things. Remember the definition of a discipline. It's not punishment. A discipline is that small thing that you can do that will help you grow the muscle to achieve the really big thing that you could never do if you didn't do the little thing that grew the muscle, that gave you the equipment, the strength, the ability to do the really big thing. A lot of my friends think it's a bit of a moral mistake for me to teach students how to become a millionaire. There's so many things that are so much more important than being a millionaire, and I absolutely agree with that. But my question today is the same question I ask the first day of every semester, and that's this. When you turn 50, if you do a few basic things, you will be a millionaire. Or you can make all of the mistakes and disregard the 3 laws of personal finance the way most people do, and you won't be a millionaire. You'll be buried in debt. In my opinion, the moral equation, really it's do the right thing so you can be in a position for yourself, for your family, and for your community to make a difference. That's what this course is about. Yeah, money and how you manage money, it makes a difference financially. But like my friend Jim Rohn always said, it's not about the goal. So the goal of becoming a millionaire and achieving that goal is one thing. But the real thing, the best thing, the more important thing is to become the person who can achieve that goal. And if you look around, you will see some who have and some who have not. And all I'm teaching you, all I'm hoping, what I'm asking you to do is to commit to the small things, to do them in a very methodical way, a systematic way, like setting up your 401k and not thinking about it. Pay yourself first. Do like JD. And you'll be in a position one day where you have way more options and way more opportunities. And that's what my hope is for you. Thanks for being with us this semester. And thanks for watching our Facebook Live. which is not really live. See you next time. This is going to record. Hi. Sorry about that. It's 1 minute until 10 a.m. We're about to go live. So everything's green. Looks like we have good technology. I've been doing tech checks all morning, getting ready for this, our final class at the university.